let you know how this works. So this is put on by FEI Dallas chapter. It's one of 7 different special interest groups that we do in the chapter, including real estate, restaurant, retail, technology, energy, manufacturing, distribution, healthcare, and something. Um, so 7 different groups there. And these groups are managed by a steering committee made up of sponsors and FEI members. And I wanted to take a minute to recognize the steering committee, Bill, who was speaking before to everybody, Bill Lesker, Chase Paxton, Bruce Cope, and Steve Smith all help sort of, create the topics and get the right speakers and make sure we're talking about stuff that energy people care about. And then the sponsors, I think she's going to change. There we go. We do have names here. Good. Brian Hudler with Alliant, Cindy Colson with Sirius Solution, Bruce Newsom and Michael Cooper with Haynes and Boone, Pedro and Cody from Moss Adams, and Larry from Larry. Did you change banks? Where's Larry? Larry from Washington Federal, maybe? WaFd? I don't know. Sorry. I'll have to check with Larry on that one. But so these guys put it together, so we appreciate that. And when we have events with booze and such, the sponsors are sweet enough to pay for it, so we appreciate that too. And hopefully one day again we will have an in-person session, but until then we will continue this methodology. So during the presentation there will be polling questions that will pop up on your screen. Please answer at least 3 of the 4. If you want to get credit for your CPU, you must answer 3 of the 4 questions. The answers don't have to be right. There is no wrong answer for many of them. They are there to make sure that you are breathing, alive, paying attention, and present, so you can miss one of them. Throughout the sessions, we're going to be doing questions that will be focused towards, who's our moderator? Someone tell me the moderator. It's over here. The moderator is...
I'm the moderator, Eric. Chase.
Chase. So sorry about that, Chase. Direct your questions through chat to Chase. Chase will interject the questions as he sees fit or at the end of the presentation. As well, at the end of the presentation, you are able to do the raise your hand functionality, and we will call on you and unmute you, and you can ask your questions personally. Now, this is the part I've got to read, and then we're going to go for it. Today's webinar is worth 1 continuing education credit, CPE. To be eligible for CPE, you must answer at least 3 of the 4 polling questions and have a total viewing time of at least 50 minutes. Participants will receive CPE notification email when the credits are available, typically 7 to 10 business days. We are unable to grant CPE credit in cases where technical difficulties preclude eligibility, i.e. technical difficulties. CPE program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to satisfy the minimum requirements. I don't know why I have to read this, but I've been told I have to. In accordance with the standards of the National Registry for CPE, sponsored CPE credit will be granted on a 50-hour basis. We're done with all that. The timing starts now that I introduce Mr. Chase Paxton, Director of Finance and Valuations for NGP Energy Capital Management. Thank you.
Thanks, Eric. Well, welcome everybody. I'm glad that we're able to have this. Our last meeting was planned for the end of March, and at that time we thought the topic that we're going to speak on tonight was going to be really timely. We had titled it Oil in Transition, Evolving Investor Demands, and we thought the major issues that were going to be hitting the oil market were a price war initiated by OPEC Plus, a real switch and focus on upstream producers on the lower 48 to capital discipline, to dividend discipline and distributing free cash flow, and a little bit about increasing ESG concerns. And while all that's a factor and something that we're going to address some tonight, since then we obviously had a lot of surprises in 2020. We had a pandemic and an unprecedented global economic shutdown, peaking with negative $40 oil prices. We had a significant and continued pullback in public equity prices for oil and gas companies, a significant pullback in lending and capital availability to the sector. And more recently, we have a likely change in the executive branch that's going to bring additional industry regulations. We've had a slew of bankruptcies, additional M&A consolidation, and recently announced large, wide-scale layoffs at some traditional, very large oil and gas entities. And the focus on ESG has not only become about ESG and accelerated, it's also been about shifting a lot of that capital to energy transition. And so, with that backdrop, I'm privileged to introduce our topic and our speakers tonight, who will be talking about the U.S. upstream market and moving forward from the commodity crash. And from WoodMac, which is one of the leading global economic and policy and research consultancies in the oil and gas, we have Rob Clark, who's Vice President of their upstream research. He's been with WoodMac for 15 years. He was one of the original founders of their oil and gas research group on the original team there. And he's someone that spoke to our FEI Energy group before. And joining Rob is Ryan Dumont, who's the research director for the lower 48 in their upstream practice. Ryan specializes in basin characterization, decline analysis, economic modeling, competitor analysis for WoodMac. As Eric mentioned, just remind you, you can chat questions to me during it. We'll try to address those, and I'll try to help moderate that as we're presenting. Presentation will last approximately 50 minutes, including the Q&A. And with that, I'm going to turn it over to Rob and Ryan and let them go ahead and share and walk through their presentation.
Great. Thanks, Jace. Thanks, everyone. How's the audio? Can folks hear me? Is it pretty good? I'll take that as a yes. I can shout a little bit louder if I need to. Thanks for the introduction. Thanks for the opportunity. I think Chase kind of hit on all the key points in his kind of 60-second intro about kind of what's going on. I was fortunate to speak to the group a couple of years ago and really enjoyed it. I've maintained some relationships around the DFW area from that. So Chase, thanks so much again for the opportunity. I am coming to you live from TCU. I teach a class in the Energy MBA program called Current Events in Upstream and Oil and Gas Analytics. And I just want to give just a subtle plug to this program in all honesty. I guest lectured for a few years. I'm fortunate to teach a class now. If there are folks within your organization in the DFW area that are thinking about sending junior folks or associates to business schools specifically to look at energy, I've just been massively impressed with how the program at TCU has developed. So that's just a slight plug to look at that. Okay. Ryan and I are going to talk for about 30-ish minutes or so. We actually cut a few slides out of our deck yesterday because we had a hunch that there might be some questions around the election and some questions around M&A by the end of the year, looking at what's happened with Pioneer, Parsley, and ConocoPhillips and Concho. So we did cut a few slides to open up some more time for questions. Ryan's going to drive the deck. We're going to go back and forth a little bit. We're hoping that the change of pace and the change of delivery keeps it as lively as possible. And with that background, I think we will get into it. So Ryan, if you could go to the next slide. Thank you for driving, Ryan, as we go. I just want to put this up here because you'll see the footer in most of the charts that we use are from Wood Mackenzie Lens. And as WoodMac grew over the last 40 or so years, we had research offerings and data sets of models and written pieces of content that were sort of segmented, just individual models and offerings. But we've been undergoing a massive journey the past 3 years now to get onto that and to get all that information into one centralized data set. And that's called Wood Mackenzie Lens. So when we get to the end of the talk, if there's anything that you think would help your business, please get in touch. I think Ryan and my bios and contact information are at the end of the deck. And if you choose to go a different way, you'll see the top right of that slide, woodmac.com/lens. Okay. For folks on the line, if you go to the next one, Ryan, if you don't mind. For folks on the line that may not know about us, I just want to be clear of kind of where we're coming from and the value that we add. So we don't provide financing for the energy industry. We don't participate in wind or solar projects or wells, right? We don't finance. We're not working interest partners. We are a research and consultancy group, and the biggest value that we add is being thorough and independent. So if we think a company's not doing well, we'll tell you. If we think a project's not doing well, we'll tell you that too. Okay. WoodMac is part of the Verisk company of businesses. So that's a publicly traded organization. VRSK is the ticker. We make up the energy vertical. The Latin translation of Verisk is ver is truth, and then risk is just risk. So what can we do as an organization to give you truth in data sets of models of opinion to help you remove risk from your business? So we provide, as this slide shows, data sets, models. We have over 500 analysts in the company. And our whole goal is to help strategy teams, policy teams, new ventures, market analysis, et cetera, everything in the middle there, basically take risk out of their business. Okay? So that's the kind of 2-minute intro as to what WoodMac does. I just wanted to put that out there in case there are some folks on the line that are kind of listening to Ryan and I go through and scratching your head and going, well, what role does this company play? Are you in projects? Are you not? Do you provide financing, et cetera? Okay. So with that, we will dive right into the content and appreciate everyone sticking with us through the intro. Okay. So we're going to talk about shale. We're going to talk about tight oil. We're going to address some of the most critical questions that we're getting inbound from clients. And we're going to talk about the nuances of some of the things that may make it into the headlines a little bit. If you're just looking at the performance of some markets, we're going to kind of dig into what's going on there, right? So in regards to U.S. shale, I'm just going to move this screen here. Without a doubt, as Chase said, the sector is struggling. You look at equity performance, you look at the cost of capital, it's hurting, right? Well, one thing that's important to recognize around that is this is a sector that's had to redefine itself every couple of years, right? So what we've done here is we've taken all production from assets that we categorize as tight oil plays, and we plotted the production, just simple annual numbers from 2011 kind of up to today, and you can see production peaking in 19 on an annual basis, right? And just think about the price signals that were coming from the market through this period, right? So we were north of $100 oil in that first section, and it was all about growth, new plays, show me a big well, I'm going to produce into the Super Bowl market, right? But what did the market value during that time frame? Well, we can actually put numbers behind this, right? So the 3 company logos on the left for Continental, Pioneer, and EOG, those are companies that when we looked at all WoodMac's NAV models and built up a value for those companies, the public markets were valuing those firms much higher than we were, right? So there was reward for volume growth, big wells, new plays, etc. The market goes defensive after the crash, and then the goalposts quickly changed to show me a defensive strategy, right? The rhetoric was lower for longer, so the play was, okay, if prices stay down here forever, I can last forever. I've got thousands of locations that on a half cycle basis work sub 40, right? Lower for longer. So then it evolved to a story of show me stacked pay, show me low cost inventory. And then after spending habits kind of changed, it became about cash flow, right? You retooled your businesses, you shrunk. Now prices are on the up. Where's the cash flow? And I'm going to get into this in a couple of slides in some real detail, but the goalposts changed again. And now they've changed again. Chase talked about ESG. Show me a sustainable business. What's your carbon footprint, right? So this is a tough sector when the ask changes every couple of years. The really important point is look at the logos on the right. So under the same methodology of comparing our NAV to market value, the companies that are favored are completely different, right? These are companies with diversified portfolios. These are companies with conventional assets. These are companies with a lower recycle ratio, a lower underlying decline rate, right? We understand, just to summarize, we understand why shale has been pressured by the markets, but we need to be fair and recognize that every 2 years they've been asked to do something else. Okay, so on the next slide, and then I'll pivot to Ryan. These are a whole bunch of models put together to kind of give you a sense of kind of why this sector is struggling to produce the type of financial results that investors want right now. So the graph on the left, we took all the detail of the axis because it's really about the story, right? So across the X, IRR increases to the right. This is a histogram, so these are different bins. And future spend is on the Y-axis. So each one of those bars represents a set of IRR returns on the next well drilled in a project, and across the country, how much CapEx is going to be spent in that asset, right? There's some good news and some bad news. The good news is, if you start at the left, things are generally up and to the right, right? So as IRR increases, we allocate more capital to those plays. Thumbs up, right? The bad news is the outliers. So the really high IRR stuff, there's not much future CapEx allocated to it. Well, why could that be? For two reasons. One, we've drilled a lot of the good stuff already. And the second point is, you have to think now in terms of fields, not plays for shale. So the best rock is great, but it's not hundreds of thousands of acres. It's 20,000 acres here, 20,000 acres there, right? So mixed results on the graph on the left, some good news, some not so good news, right? But when you look at tidal projects, if you're not super close to this, these are monsters, right? When we look at total committed CapEx to shale versus other resource themes like deep water or oil sands or onshore conventional, globally, tidal is going to consume about 3 times the amount of capital over the next 20 years. So these projects are humongous. And it's not just about the spend that goes into the next well. It's the infrastructure that has to be built. It's the land that has historically been acquired, things like that. So when we add all those numbers in, and we run discounted cash flow models, so the graph on the right, each horizontal line, they're real skinny, but that represents one of about 800 company-specific projects that we hold in our database that we model, right? And they're ranked high to low. When you look at this, only 35% of projects have delivered cumulative cash flow that's positive. That's a little bit scary, right? It's all this associated CapEx. There is a silver lining, though. There is a silver lining. The projects that look the worst are the youngest, Permian. The projects that look the best are the Bakken, most mature. So this concept of kind of tidal going to investors a decade ago and saying, hey, we're going to outspend cash for 3 or 4 years, but trust us, the goods will come. You know, this generally holds true. The frustrating bit for tight oil has been how it's had to ride the price cycles. So the U.S. hits all-time production peak in March of 13 million barrels a day, and as Chase said, just to see prices go negative, right? You're not going to have good metrics under that situation anywhere, right? So that's a bit of a backdrop. That's a bit of history, a little bit of context on why the sector is struggling financially. I want to pass it to Ryan now, because he's got a really cool graphic that characterizes how financial health has evolved.
Yeah, thanks, Rob. So at the asset level, I think it's no secret that a lot of tight oil projects have struggled to deliver cash, but that's taken its toll over time as we roll it up and kind of look at the financial health of this sector over time. And so I'll explain a bit what we mean when we say financial health, because this is a WoodMac metric that we've pulled together. So what we're trying to do is be able to clearly show in comparison to one another how companies' financial health has changed over time. And so we're ranking here about 30 or so lower 48 focus upstream companies. And it's a combination of some publicly disclosed financial data with some of our in-house metrics, so things like the WoodMac valuations and production data. And so we bring those things together, things like gearing ratio, WoodMac NPV, debt to NPV for that matter, credit rating, next maturity date, weighted average bond price, current ratio. And when those things come together, we rank companies 1 to 10, with 10 being the strongest. And it gives us ability to see, as we see here, different vintages. And we're looking at 3 vintages, Q4 2016 being the gray, when things, relatively speaking, looked a whole lot better. The blue being from Q4 2019, where you can see massive shift leftward, and then companies by and large got significantly worse from a financial health standpoint. And then a third vintage, Q2 2020, in that red or magenta, showing some modest improvement, but still by and large, companies being significantly worse off than what we saw in 2016. One of the things that I think is incredibly interesting, though, is as you look at each of the vintages and the companies underpinning the different rankings, is that we continue to see more and more polarization between the healthy companies and the distressed companies. And so what we have is, on the left, the companies that kind of fall below that 4 mark. And this is going to be our distressed indicator. Over time, we found that companies that sit below 4, for several quarters are most likely to either file for bankruptcy, have some sort of restructuring, or just in kind of a almost zombie state. And so here we're looking, now at companies like Gulfport, Callan, SM, they're sitting there. But then on the other side of the spectrum, you've got companies like Conoco, EOG, Devon, and Near. As we all know, 3 of those 4 just made some pretty notable acquisitions. So the difference between the haves and have-nots, if you will, is beginning to, or continuing to get wider and wider. And so when we think about that blue to red shift, where we saw that modest improvement, it looks kind of minimal, but what we found is that, the companies that are doing well had a number of common themes that really played into it. So you had the likes of Concho and Pioneer earlier this year doing things like issuing tender offers on their upcoming maturities, new long-term debt with lower interest rates, and then some of their other peers, the ones that are doing well, relatively speaking, you're talking about reducing your cash burn as they shift to more of the maintenance capital programs, able to restructure some debt, issue some equity, curtailing your dividends and buybacks, and then also taking advantage of the OFS deflation and realizing some capex savings. On the other side of the spectrum, we look at the blue there's more of the wedge that sits below that 4 mark. That's Chesapeake, Whiting, Ultra, companies that filed already for bankruptcy. And, now we see risk of, several other companies, especially if we sit at $40 for any sustained period of time that might follow suit. Bottom line, you look at a number of the companies that are the lower portion of this, got high credit facility utilization, their debt to asset value ratios, all that comes together, and we see less financial flexibility for some of these companies. But within this, when we look, one of the things that's varied over time and is incredibly important to consider is what the spending habits of some of those different groups have been, because that's gone a long way, I think, in kind of creating some of that division that we saw. So Rob's going to talk us through this chart here, where we look at some of the groups and what we've seen over time.
Thanks, Ryan. Yeah, so I've got 3 slides, and then I'll pass it back to Ryan, and I'm going to talk about spending habits and the slowdown in that, and then ultimately deleveraging, right? So this time slice here of about 10 years maps over to what Ryan showed on those distribution plots on the slide before, and it shows year-over-year change in capex on the primary y-axis for 4 different groupings of companies. So a large cap independent, like a Pioneer, a company that may be large but multi-basin, diversified US, so think Marathon, and then the Permian pure plays, and then we put Appalachia in there to represent the gas markets. Okay? The yellow line is WTI, that's on the secondary y-axis. And there are a couple big takeaways from this chart. So obviously changes in yearly spending habits with price fluctuation, no surprise. But looking at the different groups, it's interesting historically, and this is where it matters for the macro, that when we've had little blips in the price or even larger corrections in the price, like in 15, it's typically been larger companies that have shown greater restraint. So they cut the most and they kept budgets down when prices rebound. Okay, this is something super important if you try to wrap your head around what is the Permian going to do in the next few years. What is U.S. tight oil going to do in the next few years, right? Because it's been the largest companies that have kept with this trend in 2020. So look at Chevron's budget cut, right? Look at Exxon's budget cut. Look at what Oxy did after it purchased Anadarko. It took the combined Permian budget and it cut it by 50%, right? If you're in the camp that thinks that Permian rig count in a couple of years is going to get back to where it was at the beginning of this year, that's an interesting debate to have and an interesting argument, right? The bigger companies are controlling the Permian now, and with even more deal flow, as we touched on up front, the companies that remain are going to get even bigger. And these companies, ironically, their activity response is inelastic to price, which completely bucks the trend of what tight oil was predicated on, price flexibility, right? It's fascinating to see budgets evolve. Let's go to the next slide, Ryan, and let me walk everybody through historical uses of cash in the sector. We can spend a lot of time on this slide. It looks like the meeting's recorded. I encourage folks to go back and really absorb this if you like. Well, what we do with this slide is we try and break a myth, right? And there's a myth out there that 2020 is the year that tight oil changed, right? So the slide I showed before, it did show some variation, but still a propensity to kind of spend a lot of money, right? Tight oil kind of started to right the ship from a capital perspective about 3 or 4 years ago. Let me walk you through these charts. It wasn't just a 2020 event. So the chart on the left, the footers give a lot of detail, right? There's basically about 30 companies included in these charts. What the chart on the left said is starting on the 1st of January 2010, sorry, these aggregate companies had $19 billion of cash on the balance sheet. Okay? From all their production over that 5-year period, they took in $520 billion. Excellent. Here's the problem. They spent 632. Okay. They did a little bit of net A&D to claw some of that back. They issued some debt, right? Net equity is negative because you'll see in the footer there were some dividend increases and some repurchases, right? And basically, at the end of that year, that 5-year period, they ended with $38 billion of cash on the balance sheet, right? Note, though, that during that period, WTI averaged $91 a barrel, right? So this is a pretty meteoric use of cash, right? And at the end of 15, this is kind of when the pressure starts to come on these companies. You know, hey, folks, why do you spend so much? What's going on with the shale treadmill? Can you adjust your behavior a little bit? Well, let's look at the same chart on the right-hand side of this slide for the next 5 years, right? So the 1st of January 2015 through the end of last year. So they start with that 38 billion, right? They bring in 330 billion from operating cash flow. They overspend that again, but not by as much, not nearly by as much, right? There's a little bit of net A&D. The debt story changes, the equity story changes, right? And they end the period with a little less cash on the balance sheet. Here's the really interesting bit, though. During that 5-year period, we went through the absolute Permian activity boom, right, in 16, 17, and 18, and WTI averaged about $40 a barrel less than it did in those first 5 years, right? So to say that 2020 is the first year that tight oil spending habits changed can be true in the sense that now everyone's spending less than operating cash flow, but it's not fair to say the sector only changed this year. It was going through a bit of a progression to be what we could say maybe better stewards of capital. It's really interesting. We'll go to the next slide, Ryan. And this is where I'll kind of bring it to current events. So now, the reining in of spending is even more aggressive, right? So historically, over that 10-year period that I showed, companies spent about 120% of cash flow, right? They put that back into their assets. Now, investors in public markets have said that is too much. There's no way this is a sustainable business. There's no belief in the market that prices are going to get back up to 80. So you need to live within your means, right? And companies have kind of been given the option to spend 70% of operating cash flow, and that's it, nothing else, right? Now, with that, they also want to show investors that we're sustainable, right? We can survive. So the combination of metrics that's working in the market now is stay flat production, only spending 70% of cash flow. The kicker is not everyone can do that, right? If you're really interested in this combination of metrics, if you look into the details of Concho's sale to Conoco, Concho basically says, we don't think we can do this. You know, we have a pretty aggressive underlying decline rate. If we only spend 70% of cash from operations, we don't think we can stay flat. I'm paraphrasing, right? But there's detail in the disclosures around that, right? So not everyone can do this. We took on a big exercise, which is what the 2 graphs show, to look at all the companies listed on the x-axis there. They're in different orders for each graph, right? And we looked at them under 2 different price scenarios. So $50 flat and $60 flat, right? And the way we model this in the simple sense is it was pretty complicated, but if companies need to stay flat, right, and only invest 70% of cash flow, do they have anything left? Some do, some don't. Okay? If you do have cash left at these different prices, what were to happen if you were to apply all of that to debt overhang and start to pay down debt as fast as you can with a goal of getting to 20% gearing, which is what we kind of think the acceptable number will sit at. It's about 1.5 times debt to EBITDA. Okay? So who can get down the fastest to 20% gearing? Now, what plays into that? Well, asset quality is huge, right? How fast is your underlying decline rate? If that's steep, you got to spend all your money to not shrink. If that's shallow, you'll have cash left over to delever. And at $50 a barrel, the average numbers, it takes about 3.5 years, pretty lengthy, for that subset of companies to get down to 20% gearing without going to the debt markets, right? Sorry, or the equity markets. At $60 a barrel, the story gets a lot better. So if we're at 60 for 2 years, we think companies, for the most part, can end up where investors and institutional investors want them to be, right? I think some important takeaways here that the sector can fix itself, but it can't fix itself overnight. We get the question a lot: how long? How long are we going to be in the situation where companies are very defensive? How long is it going to take them to get to a point where they're investable again? At 60, we'd argue the answer is somewhere around 2.5 years. So I know I threw a lot at you. The slides will be available after, but it's an interesting way to think through that problem of how long are we in this situation? How long are we in this tug of war, right, with budgets? So Ryan, over to you.
So, I mean, building off of the idea that companies are going to be super focused on deleveraging, which is fantastic, but then going forward, what are some of the other thematic goals that we think companies might want to start to target as they look to not only get to a point where they can consistently generate free cash flow, but ultimately get to a point where their strategies are going to be appealing once again to attract more investment into the sector. And so there's kind of 3 double things that we think, companies that are going to position themselves for success would want to tackle. And the first, and it sounds quite obvious on the surface, is just having exposure to the bottom of the cost curve. But this means more than just simply developing your best rock. In addition, it's going to be having access to very competitive oil field services, because basically you need good rock and you need to be able to try and keep costs low and ideally push efficiencies and productivity higher, or at the very least, just keep them at where they're at today. The other thing too is you want to be working at the bottom of the cost curve because you want to have a high likelihood of drilling a consistent number of high performing wells. We'll get into some distributions in a little bit, but this is something that's definitely easier said than done when we look at what future well performance might look like. The other thing is that you can't just have a little bit of exposure to the bottom of the cost curve, but it really comes down to having some scale. So the best companies are and will continue to be those that have an ample number of ultra core locations. Basically, the companies that are able to continue to invest when prices are low or we see price volatility. The other thing that's kind of shown up over and over again is companies that have exposure to several areas. And it doesn't necessarily have to be exposure to several different tight oil plays or tight gas plays for that matter, but just having optionality. This is one of the common themes when we start to look at companies that are able to consistently generate positive returns, is that they're not necessarily going to be the ones that follow the pure play business model. If we think again to companies like ConocoPhillips at kind of the front of that financial health index throughout all of those different vintages. And then finally, and arguably most importantly, would be you want to see operators that are on firm financial footing. And there's a number of different ways that you could quantify or lay out what firm financial looks like. But when we start to think about it, you want companies that avoid continually outspending cash flow. They're going to avoid chasing growth simply because their peers or neighbors are doing it. And then avoiding short-sighted resource development. And so chasing things like high IP rates, but rather think about how could you develop your assets so that you are able to achieve low decline PDP volumes. And so if you can bring these things together, quite literally, it can help pay dividends. But these are some longer term thematic goals that companies would target. I think, one of the things that's more immediate, and it kind of relates really well to what Rob just showed, was the idea of limiting outspend. And so what we're looking at here is again, lines colored by different company groups. But here we're looking at the reinvestment rate. So CapEx versus operating cash flow from 2015 out through 2025. 2015 through 2019 represented by actuals from company filings. And largely what we see is that companies have been reducing capital intensity since 2015. So back to Rob's point, this isn't something that changed, starting Q1 this year. This has been underway. And really it was led by companies like ConocoPhillips, back in 2016 in a big way. So, it's the diversifies and multi-basin companies that push the needle most. When we look at some of the Permian pure plays, they were still outspending, into last year. So I think that sometimes, if you look at just reinvestment rates, that's where folks might say 2020 is a bit different, is if you parse out some of the Permian pure play behavior versus some of those other companies. So then what happens if you have a situation where, as Rob said, a lot of companies targeting the stay flat production, you're limiting reinvestment to 70 to 80% of operating cash flow. And then while the price scenarios he showed were 50 and 60 a bit rosier, what if we limit that to 40, given we're seeing about $38 today, and just say, let's take a pretty conservative view on prices. And this is actually pretty interesting. It was surprising to me when the team started pulling out some of these results. But about half of the E&Ps can keep production flat at $40 a barrel flat with sub 80% reinvestment rates, including a lot of Permian pure plays too. What becomes arguably more interesting, though, is if you just increase prices by just $5, so $45 a barrel, what you find is nearly everyone at that point can stay below the reinvestment rate threshold and keep your volumes flat. So if you start to get slight increases in price, it's going to increase the odds for companies to be able to make good on kind of this self-imposed reinvestment threshold. So then the next big question, starts to become from a lot of our clients is, where do we go from here? 70, 80% looks like it's possible, but is that enough? And so we think as the industry continues to consolidate, that's actually going to push lower, maybe getting more towards 50, 60% on par with some other capital intensive industrial sectors. Companies like ConocoPhillips, again, already leading the way, lowering the bar below 70%. Continental just today said that they're going to look for 65, 75% reinvestment rates for their 2021 program. The thing, though, that starts to get really interesting, I look a lot at some of the supply modeling over the years, is when you start to combine lower reinvestment rates, the need for companies to reduce their leverage, and the fact that tight oil business model continues to evolve each, I guess, every 2-3 years almost. What does that mean for growth? Should we expect tight oil to grow again, or what are some of those triggers? So we've got a few scenarios here that Rob's going to walk us through and what could trigger some of that growth again.
Absolutely. I think I unmuted. Yeah. I guess one other thing from Ryan's slide that just popped into my mind as I was looking at it is, the treadmill is super steep when you're drilling a lot. But when you slow down drilling, you have a smaller amount of new volume that comes from rapidly declining wells. And this is probably, I'm thinking out loud here, this is probably illustrated a little bit in this being kind of an okay situation as you get a few years out to the future, because you're not drilling as much, because you're only spending 80% of cash flow or 70%, you're drilling less and less. So as you get out into the future, actually that lower reinvestment at a lower price is kind of sustainable. It's the $1 trillion question, right? Is this what's going to make tight oil investable again, right? Can you have a company that doesn't shrink, that can deal with low prices, that can de-lever, and that can support its dividend if it pays it, right? So we'll go, I just wanted to just kind of get that off my chest, Ryan, as I was thinking about it. This slide kind of pulls a whole bunch of detailed models into 3 simple graphics. And we put this in here because there's been a lot of rhetoric out there, whether that's been CEOs speaking to the Financial Times. I think of Matt Gallagher, the current CEO of Parsley before the deal closes, famously being interviewed, and other CEOs as well, but saying, the US will never hit 13 million barrels a day again, right? What that really means is tight oil is past its peak, because Gulf of Mexico flat in the medium term, Alaska kind of flat in the medium term, it all comes down to the Permian, right? And I would love to have the conversation with some of those folks and ask, well, I don't disagree with the view, but I want to know at what price, right? Because at $30 a barrel, tight oil is really bad. Like Ryan said, just a $5 change in the price can profoundly impact the financials of a lot of these companies 5 years in the future, right? So you can imagine how good things look at 70, right? So what we did here is we took all these models and we ran them through a pretty detailed supply model to show what cash was available for reinvestment, et cetera, et cetera. But what could tight oil do at various price bands? And the swings are huge. So starting on the left, if we're at these prices are a little bit less for kind of perpetuity, right? Then tight oil is past its peak. No doubt, right? If we're at 50 for perpetuity, right? It dips for a few years, and that line represents what we currently hold as we call it our base case view, but under our own price outlook, which isn't flat, right? It dips, and then it kind of gets to a sustainable model. But if something happens where in the short term prices go to 70, and that probably sounds really, really far out there for a lot of people, but it could be a geopolitical event, right? Could be something on the regulatory front. There could be a vaccine. I'm tossing ideas out there now that's widely adopted, right? If demand jumps, supply has some other additional impact, we'll call it geopolitical, prices go to 70, right? Tight oil will grow again, and it will grow pretty fast, right? So a big question, crude exports, how sustainable is the business? It really does come back to that price view, right? And that is a huge swing, 30 to 70. But to claim that tight oil is done now, we think is a little premature. As Ryan showed, it will take time, but we believe the financials can heal themselves, but there's a ton of upside at higher prices. So I'll pass it to Ryan for a few more slides, and then I think we'll go to questions.
Yeah, perfect. So, all right, we've talked about the corporate side of things, what sort of strategies companies will likely be thinking about, the price or the impact of price on supply. But then, the kind of third thing to round out the trifecta, if you will, would be, operationally, what do we need to think about, as we're moving beyond this downturn? And the first kind of elephant in the room, if you will, is going to be thinking about infill well performance, and the reality being that the well you drill tomorrow is arguably unlikely to be as big as the well that was drilled yesterday. And so what we're looking at here is a lot of well data, in this left-hand chart. We're looking at individual well results for the Delaware Wolfcamp, colored by county, but showing the distribution on the x-axis and the estimated oil EUR per foot on the y-axis, just to give a sense really quickly of how wide that performance distribution can be. And so when we start to think about drilling infill wells, and the reality that more and more wells that will be drilled, or a greater proportion, are going to be child wells going forward, trying to understand what that performance looks like is going to be one of the most important variables operationally as folks plug into their models and start to think about, okay, what are those CapEx requirements going to be just to keep production flat, let alone grow if the price signals are there. And the short of it is that the EURs are likely going to be smaller than what we may have anticipated to date. So a lot of the technical research, when this really started to come about, 2017 or so, 20-30% was a solid rule of thumb for what sort of haircut you might be able to expect in child wells compared to those parent wells. But when we start to look, and you just use this chart kind of as a simple gauge for that, and let's just roughly assume 1 in 5 wells per pad is going to be a parent well. Everything else is going to be a child well. So kind of that 0 to 20% on the x-axis, maybe representing what the parent well performance would look like. And all of a sudden, as you start to think about wells 2, 3, 4, 5, and you start to move down in the distribution, you're looking at numbers. If you go from, say, just 300 to 150, maybe a 50% haircut is maybe more appropriate. And so in that simple case, there's kind of pros and cons to looking at it in that view. But one of the things we found over and over again is that, when you see situations where wells are spaced, closer than 660 feet, when the completion timing between the subject and the offset is greater than 30 days, so you have, massive differences in the downhole pressure, a 50% difference is not out of the realm of possibilities, and it's something that we all have to be aware of as we continue to see us move towards, what one of our colleagues calls an increasingly child well world. So then with a lot of folks, realizing that, infill wells are going to be smaller. I don't think there's much arguing there. You could probably argue that the degree of the severity, especially if you start implementing up spacing and better sequencing, costs start to really enter the equation. And earlier this year, we started getting a lot of inbound questions from some of our clients, wondering whether you could envision a scenario where, even though the wells might produce a bit less, could cost control and cutting costs result in a situation where the child wells are still economically competitive with the parent wells. And it's possible, but you have to see a lot of things go right. So the thesis being that, with the parent well and maybe even just the first and second child well, a lot of the infrastructure spend was already capitalized. You might be able to employ a lighter completion in the child wells. And then also the fact that since, late 2018, we've been in this massive deflationary period for costs. And what we found is that you have to see basically a one-for-one reduction in cost to how much you've lost in productivity. And so if you have kind of the more conservative case where productivity falls 10, 20%, then you could certainly envision a case where those child wells could be as economic for parent wells. The timing, though, starts to become a bit of a question mark, just because the sustainability of some of those cost concessions that we've seen lately are questionable, just given we need to see the OFS sector get to a point where it can at least operate in a more sustainable fashion and claw back some margins to at least cover some of those variable costs. So it's something that's not going to necessarily last forever, but bottom line being that child well economics may not necessarily be as bad as we thought, despite some of the performance being quite a bit worse in some cases than what we thought. But then, thinking that cost control is important and economic competitiveness is important, but then what happens if you don't have to drill that full distribution of well results? And instead of focusing on drilling increasingly bigger wells, what if we just focus on not drilling as many poor results? And then it sounds pretty simple, and I've imagined some folks on the call are saying, of course, we're not trying to drill poor performers, but this is something that actually, it has a big impact. And the reality is that there are a lot of wells that kind of are well below average that do get drilled each year. So then what we're looking at here is, on the left-hand side, a spaghetti plot showing individual well results, kind of time normalized declines, showing the P50 in the light blue, the cumulative showing the cumulative P50 in the dashed line, and we also include P10 and P90. So then if you had a situation where, companies, let's say they don't have to push to tier 2, tier 3, or they could just minimize drilling some of the poor performers, let's erase the bottom 50% of those well results. And that's what we're looking at in the chart on the right then. And so this removes about 600 wells from the sample set. And it has a profound impact on both the performance and the economics. So first, we see that EUR increases by about 150,000 barrels. But then what's really interesting is that we see, the PI ratio increases and the PV increases by about 55%. So then when you start to kind of bring all this together, and we're looking at 30 months worth of production here, and so if you remove those poor performers, you remove also $1.7 billion worth of value destruction in core Permian activity. And it's worth noting too, the results that we're showing here, are from a lot of the major Permian producers. So companies that should very much know what they're doing. So that's the, kind of to say that even the best of the best don't always drill top performers, despite what we might see in some of the IR decks. So if you can avoid drilling some of those, and this is driving a lot of M&A activity, as companies look to replenish that tier 1 inventory and avoid having to shift to some of their lower producing acreage. But then beyond, cost control or just avoiding drilling the poor performers, and you want to still look for areas, where can you keep production up and spending down? This is another common question we get from a lot of our clients is, what areas, kind of are things that people should keep on the radar, because there is ultra core acreage out there. A lot of it we know, places like Midland, Martin counties in the Midland Basin, for example. But then what about, if we move a little northeast into Howard and Borden counties? And so we recently wrote a piece, did some research looking at this, because when you start to look at companies like SM and Surge, their well results were pretty impressive. And then when you couple with the fact that these wells tend to be a bit shallower and they're a bit cheaper, you're starting to look at some of the best capital efficiency metrics in all of tight oil. And actually, we do a lot of basin benchmarking for different areas geographically within the plays and from reservoir standpoint. And this area in Howard County actually moved to the front of the stack, with half cycle break evens, sub $30 per barrel. So quite impressive. This is somewhere that's got great oil cuts. It's as productive in many cases what we see in Midland Martin County, but it's an interesting one because SM, I mentioned when we were talking about financial health, not necessarily in the greatest financial footing. So begs the question, is there an opportunity for potentially someone to come in and look at some pretty attractive acreage? Not that they bought SM's acreage, but quickly after we released the insight, saw that Laredo Petroleum actually went in and made a small acquisition. Something that's not necessarily going to move the needle for a lot of folks, but they bought a few locations, a couple hundred barrels a day. And this is just a good example of a company that kind of looking at that strategy to improve their situation. So the chart on the left showing the inventory buildup by basin and play. And what you can see is that, they don't have much inventory that's going to work at today's prices. And so if you can get access to some of those locations, even, say sub 20 locations, which is what they just bought, that's going to be a good hedge against some of the lower oil prices and give you some near-term runway. And the fact that you don't necessarily have to pay Midland County prices is also good as well. And so we see that they're offset to SM, in this area, and it's going to go a long way too, because if you look at their Howard County asset, you're looking at likely about 80% oil cut versus what they have in Glasscock and Reagan counties. It's about a 33% oil cut. So shifting not only to more economic acreage, but more oil-rich acreage too. So this is something where as we see assets continue to shuffle, whether it's companies looking to kind of replenish their front of the cost of supply stack, or looking to just go after outright acquisitions, looking at some of those ultra core packages is something we'd expect to see more of. So I think last slide over to Rob, and then we're going to open it to Q&A.
Okay, so we've got about 10 minutes left in the hour, I think. I'll just leave this slide up here because we've touched on all these things, maybe except for political risk, but I think there's a question about that. We use the slide as a backdrop, and sometimes we can just present with this slide for half an hour just to talk about risk, right? As tight oil has matured, there are all sorts of little issues that have grown, but when you look at them all together, it adds a whole lot of uncertainty around how the sector is going to pan out. And we're not saying that to sort of, shy away from putting a view down. I mean, we've got a view down that we showed in these slides about how this pans out, but it's very, very hard planning decisions is what we're trying to get to with this. So you've got some elements that would allow portfolios to shrink, some that would allow them to grow. Some are very dependent on price, like bankruptcies and cash available for reinvestment. Some, it doesn't matter what price does. You're going to have these issues in the portfolio, like Ryan talked about, infill well underperformance. We haven't talked about ESG much, but the momentum is only in one direction for that to be more important. growing U.S. political risks, which I think we'll get to in the first question. So tidal portfolios are under a lot of pressure because of price, but also a whole bunch of other factors that just make it a tough resource to manage. And just tying it all together, some of the deals that have happened that basically add diversification into the portfolio, like we really like we like Devon WPX. We think that the Conoco deal was a good move for Concho. This idea that we can just build a company in one basin, we need to flush it out more, but we're not as on board with that. And I'm, talking about a deal like a Pioneer Parsley. So, not that doesn't have benefits on the G&A side, but just from a risk management perspective, we like consolidation. It just takes a little bit more holistic view on how to build an oil company. So, thank you for letting us go through that material. Chase, I think there was a question on politics.
Yeah, so we've gotten a couple questions just kind of around, I think an expected Biden win in the presidential election. So both about what that might mean for capital investment and maybe what WoodMac's view is on a federal land ban, but also maybe on a lower key note, what that might mean for an EPA going forward and what that might mean for upstream companies for different environmental issues, and whether y'all have a kind of a built out view on that.
Yeah, so I can make a couple quick comments. Look for quite a bit of research, even outside that sort of client firewall, to hit the WoodMac portal, woodmac.com, over the next couple of weeks that we'll touch on this. There's one gentleman who makes all his research public. His name's Ed Crooks. He writes a piece called The Pulse every Friday. And Ed will write a lot about this over the coming months. So the biggest thing globally that I'll just mention is, I know there's a lot of talk around, frac bans and whatnot, but that's kind of been in the rhetoric for a couple of years, and companies have planned around that. So basically, a lot of the companies with direct exposure to New Mexico have amped up their permitting and have done portfolio things, which is say adjustments to kind of have a really good plan B in Texas, right? So the immediate impact to oil production from any fracturing legislation, probably not there. The most important thing, though, is probably, if Biden wins, a Biden administration and their stance on Iran. But we don't have time to get into that now. But there's probably more global things in the oil market that matter more than something targeted like different rules on fracturing, hydraulic fracturing. There are some things, to the EPA point, that could be very tough for industry to manage, and it may not be as direct as, can you fracture this well? It could be around methane monitoring and more punitive fines for methane leaks. It could be things on the water side, like the Halliburton loophole. So there's a lot of stuff that could happen to make it harder to operate, and it might not be as obvious as just, hey, you can't complete this well on federal land. But even if that was the case, that's going to take time, and that's going to be fought aggressively in court, particularly with big companies like Exxon having big positions on federal land. So just a couple of thoughts from me. Ryan, what would you add?
Yeah, I think you made a great point. Like smaller legislative moves, whether I guess relatively small from kind of an EPA standpoint is important. I think the other thing that can't be ignored is we're talking a lot about the federal election, rightfully so, but keep an eye on, what's happening at the state level too, the RRC changes and stuff like that, where you look at places like Colorado, for example. It's been more state impacted changes to industry than what's happened at the federal level. So even if Biden does end up winning, we got to look at what also happens in the Senate ultimately, and then at the state level, just since it's not as clear and dry as the president kind of putting a stamp down and making sweeping changes.
A lot of the slides projections sort of show these cases where production is kept flat. What does that mean for the infrastructure, the midstream side, the OFS side, kind of going forward? Is Permian overbuilt now that it, 2 or 3 years with bottlenecks, production doesn't go back up? If under your $50 case, it doesn't seem like that growth that may have been built out, or kind of the PE-backed midstream entities expecting that growth, that it's going to come. So just curious on thoughts around that.
Yeah, so the Permian is overpiped. The Permian was going to be overpiped before COVID. I don't spend a ton of time in the midstream space. Ryan, I don't know if you work with John much on this, but I don't think the pipe situation looks particularly good. Those pipeline companies, Chase. Ryan, have you?
We earlier this year, and then late last year, before the downturn or COVID was even front of mind or a thing for anyone, the outlook was for just massive overbuild in the Permian. So I think that's just been amplified now as we look at the realization that most companies are going to stay flat, and even if prices increase, maybe they target at best a 5% growth rate. So it's not necessarily a great outlook for the midstream sector. I think for OFS, there's certainly some positives that could be thought of with this. If we continue to see some of the consolidation and more stable activity from kind of the stay flat and limited reinvestment rate, you're not going to have as many rigs as you had before, but it might make sense to think about the value proposition of having more and more of your contracts with a ton of companies like your Conoco, Exxon, Chevrons, for example, versus a whole bunch of really small mom and pop or small cap companies.
Okay, I think we have time for one more question, and I think this is a good one to end on. Is you presented these 5-year look backs kind of through 2019. But take us forward to 2024. What does that 5-year look back look like on that chart, and what are the kind of the trends in the capital spend, and just maybe walk us through your projections for the next 5 years looking back.
So I think it's going to be profoundly different. I mean, I think that bar that shows cash overspend will be an underspend. I do, and that's a pretty market shift. But by that deleveraging timeline work that we did, it's going to take best case scenario 2.5 years, right, to sort of heal those balance sheets. So there's going to be a long period of underspending, I believe, and excess cash will go to that debt bucket. I don't see anything on the equity side. Just given their appetite and just where these equities are trading at now. I mean, there's a bit of movement with equity issues being used to fund M&A, but I would consider that a little bit different. Yeah, I think those charts will be quite different. I don't know if companies are going to hoard cash. They're going to have a lot of cash at the end of the period. That will get used, but that second bar is what matters, Chase, and I do think it's going to be kind of shorter.
Okay, well, I think we're hitting 6 o'clock on the hour now. I just want to really thank Rob, Ryan again for your time today. This has been, excellent, well thought out, lots of detail kind of going into this, something that I think a lot of people in the audience are dealing with on a real-time basis. And just wanted to thank everyone again for attending. We'll look to do these virtually or in person if possible moving forward on a regular basis, and are already looking for our next meeting date sometime kind of early to mid Q1. So once again, just thanks everybody for joining, and thank you, Ryan and Rob, for leading this discussion today.
Absolutely. Thanks, Chase. Thanks, everyone.
Thanks, guys.
And we will be sending the deck out to the attendees as a follow-up as well. All right.
Thanks.
All right.